If you aim to stop working 10, 15, or perhaps 20 years sooner than most others, it isn't about selecting perfect investments or predicting market moves or even your total earnings level. It boils down to monitoring four key figures. That's all. Those who truly achieve early freedom aren't using complex strategies. They simply understand these figures and review them consistently. So, in this rewritten version, we'll cover the only four figures required for early freedom and the method to compute each one. The great thing is that once you set up this routine, it requires under 1 hour monthly to maintain everything. The initial figure to monitor is your savings rate. This drives nearly everything else. For savings rate, calculate the portion of your after-tax earnings that you're directing toward future growth. Not merely keeping cash in a checking account, but actively deploying it for returns. The calculation is straightforward. Total contributions invested divided by your monthly after-tax income equals your savings rate. For instance, if you put $600 toward investments this month and your after-tax income is $6,000, then your savings rate is $6,000, or roughly 10%. We focus on after-tax income rather than pre-tax earnings because after-tax income reflects what actually remains available. Pre-tax would include deductions for income taxes, payroll taxes, and similar items that reduce what's truly yours. Basing it on pre-tax can make solid efforts appear weaker than they are. Some might ask about employer-sponsored retirement plans like a 401k. Since pre-tax contributions reduce your paycheck before it reaches you, the cleanest approach is to include those contributions in your invested total. Though not part of take-home pay, they represent funds set aside for later. For example, suppose someone earns $80,000 gross annually, roughly $60,000 after taxes. They add $6,000 to a Roth IRA and $12,000 to a 401k, totaling $18,000 invested. Divided by $60,000 take-home gives a savings rate of 30%. What target should you aim for? To reach freedom many years ahead, consider how savings rate affects timeline using tools like the Networthify Early Retirement Calculator. Assuming $80,000 gross, about $60,000 take-home, and starting from zero balance, a 50% savings rate might allow retirement in around 14-15 years. That's demanding, and not everyone can reach it. Dropping to 20% extends it significantly, perhaps 28-30 years. Starting at age 25, that still means freedom around age 53-55, a full decade before typical retirement. At just 5%, close to the recent U.S. personal savings rate of around 3-4%, it could stretch to 45-plus years. Starting at 25, you'd work until roughly age 70 or beyond. Feel free to experiment with such calculators yourself. The pattern is clear. Exceeding average savings is essential for any meaningful acceleration. On channels like this, we often recommend community members target 15-25% of take-home pay as a baseline, with higher being even stronger. A well-known personal finance writer once noted something like, "If your spending equals or exceeds 100% of earnings, retirement depends on someone else saving on your behalf." Conversely, if spending approaches 0%, somehow sustainable long-term, freedom could arrive immediately. The core link is simple. Lower spending equals higher savings equals faster freedom. Yet, savings rate forms only part of the picture, since most projection tools hold annual costs constant forever, which rarely matches reality. That's why the second figure is your annual expenses, the true yearly cost of your lifestyle. This affects both savings rate and your ultimate target nest egg. To determine annual expenses, review your bank and credit card records over the past 3 months and total every outflow: housing, food, utilities, entertainment, subscriptions, everything. This captures regular living costs. Suppose that averages $3,200 monthly. Next, account for irregular large items: new device, vacation, major repair. Sum those over the 3 months, divide by 3 for a monthly average, say $250, then add to the regular figure, yielding perhaps $3,250 monthly total. Multiply by 12 for an approximate yearly amount. Studies show people who regularly review their finances save far more toward retirement. Those checking balances daily or weekly are much likelier to exceed 10% savings compared to infrequent reviewers. Awareness alone influences decisions positively, much like daily weigh-ins encourage better eating habits. No elaborate budget app is required, just consistent awareness. So far, we've covered savings rate and yearly costs. The third figure is your investable assets, resources capable of producing growth. This includes retirement accounts, 401k, IRA, taxable investment accounts, and cash earmarked for investing soon. Update this monthly or quarterly by summing those balances. Exclude non-financial items like your home, vehicle, personal belongings, or valuables. While overall net worth is useful broadly, for early freedom, focus on liquid, growth-oriented portions. A home's equity often stays tied up. You still need shelter, so counting it inflates apparent progress. Someone renting with $600,000 invested is typically closer to freedom than a homeowner with similar total assets but far less liquid. The fourth figure ties everything together: years to financial independence. FI. This is your projected timeline to freedom, your ETA to the destination. You want this shrinking steadily. Higher savings rate shortens it. Rising expenses lengthen it. First, compute your FI target, often called your FI number. Use the rule of 25. Multiply annual expenses by 25. This stems from the 4% guideline, allowing 4% initial withdrawal, inflation adjusted thereafter, with high odds of lasting 30 years. So $40,000 yearly spending means a $1,000 target. $50,000 spending means $1,250,000. Recent updates from the 4% rules originator suggest 4.7% may be safer today under diversified portfolios, equating to roughly 21.3 times expenses. $40,000 spending needs about $852,000. Factoring potential Social Security, average around $2,071 monthly or $24,850 yearly in recent estimates, reduces the portfolio burden further. If spending $40,000 but receiving $25,000 from benefits, the portfolio covers only $15,000, needing roughly $320,000 at 4.7%. With your FI target known, subtract current investable assets. Say target is $1.2 million and you have $400,000, gap is $800,000. Divide by yearly investments for a rough zero growth estimate. But real growth shortens it dramatically. Use a compound growth calculator, like one on MoneyChimp. Input current balance, annual additions, and expected return, often 7 to 8% after inflation. $400,000 starting plus $40,000 yearly additions at 8% might reach $1.2 million in under 10 years, much faster than linear math suggests. Track these four figures in a simple spreadsheet or note. Review monthly. Are they trending favorably? Savings rate climbing? Expenses stable or dropping? Assets growing? Timeline shrinking? Adjust as needed. Mastering savings rate, annual expenses, investable assets, and years to FI gives you everything required for accelerated freedom. If this resonated, next explore whether 300K, 600K, 900K, or 1.2 million suffices for retirement. Thanks for reading. Catch you in the next one.